February 13th, 2026. Silver is trading at $82.49 per ounce. 2 weeks ago, it was $121. That's a $43 drop in less than 14 days. But here's what should stop you in your tracks. While silver crashed 35% on paper, physical silver premiums in Dubai are at 40%. In Japan, they hit 60%. Dealers around the world are reporting 2 to 3 week delays. So let me ask you this. How does price collapse while the physical metal becomes harder to buy? If you own silver, or if you're watching this crash wondering whether to buy, sell, or panic, the next 22 minutes will change how you understand what's happening. Because this isn't just about a billionaire's bet or a price crash. This is about what happens when 400 million ounces of paper contracts meet 100 million ounces of actual metal. By the end of this video, you'll understand exactly why March 27th might be the most important date in silver's modern history, and you'll know what it means for your holdings. I'm Siver, and let's examine the facts. Let's start with what actually happened. January 29th, 2026, silver peaked at $121 per ounce on the Shanghai Futures Exchange, a record. The white metal had surged 154% in 2025 alone. January 30th, silver crashed, down 16% in hours. By February 5th, it touched $76, $45 lost, 1/3 of its value. Gone. News outlets blamed speculative excess, over-leveraged traders, margin calls. All technically true. But that's not the full story. Here's what the headlines missed. While silver was crashing on futures exchanges, something else was happening. According to COMEX data, 33 million ounces of physical silver were withdrawn in just 7 days in January. That's 26% of registered inventory, gone in a single week. The Shanghai Futures Exchange lost 31.3 metric tons on February 8th alone, leaving it with just 318.54 metric tons. And here's the part that should concern you. March delivery contracts begin in 14 days, February 27th. Open interest represents between 366 and 528 million ounces of silver. COMEX has approximately 102 to 113 million ounces in registered inventory. Do that math. Even if only 20% demand delivery, historically conservative, that's 73 to 106 million ounces requested against 102 million available. These aren't speculative numbers. These are exchange-reported facts. Now let's talk about Bian Shiming. Bian is a Chinese billionaire trader who made $3 billion riding gold's rally from 2022 to 2025. He lives quietly in Gibraltar, avoids media, trades through his brokerage, Shanghai Futures. In the final week of January 2026, as silver hit all-time highs, Bian did something remarkable. He built the Shanghai Futures Exchange's largest short position in silver, 450 tons, 30,000 contracts, worth approximately $300 million. When silver crashed, Bloomberg reported his position generated a paper gain of 2 billion yuan, about $288 million. According to reports from February 6th, including previous losses, his net profit stood around 1 billion yuan. Here's what matters. Bian's short wasn't manipulation. It was a bet that silver was overextended. And he was right, at least in the short term. The crash happened. But here's the twist. Chinese regulators stepped in on February 6th. They effectively froze his position, limited his ability to add to it, and publicly exposed its size. Why? Because Bian held a naked short of 450 metric tons against SHFE's total inventory of only 318.54 metric tons. He was short more silver than physically exists on the entire exchange. This isn't about vilifying one trader. This is about understanding what this reveals. The paper market has become detached from physical reality. Let's explain what's really happening, because this is where most coverage gets it wrong. There are effectively two silver markets. Market 1 is paper silver. COMEX futures contracts in New York, London Bullion Market Association spot prices, Shanghai Futures Exchange contracts, exchange-traded funds like SLV. Paper silver is traded electronically, leveraged, fast. At one point, the paper-to-physical ratio reached 356 to 1, meaning 356 ounces were promised on paper for every 1 ounce that could be delivered. Market 2 is physical silver. Actual bars and coins you can hold, minted products from government mints, industrial delivery to factories, bullion held in allocated storage. Physical silver moves slowly. It requires refinement, minting, shipping, storage. It cannot be created with keystrokes. For decades, these two markets moved together because everyone assumed paper contracts were backed by sufficient physical metal. That assumption is now being tested. Here's what changed in 2026. First, China's export restrictions. On January 1st, 2026, China implemented new export controls on refined silver. Only large, state-approved companies with annual production capacity above 80 tons can export, and only with special government licenses. China produces roughly 20% of global silver supply. These restrictions effectively cut off a major supply source to global markets. Second, the structural supply deficit. According to industry data, silver has been in a supply deficit for 5 consecutive years. The 2026 shortfall is projected at nearly 200 million ounces. Why? Industrial demand. Solar panels consume about 300 million ounces annually. Electric vehicles take roughly 90 million ounces and growing. 5G infrastructure, AI data centers, medical applications. 70% of silver comes as a byproduct of copper, zinc, and lead mining. Higher silver prices alone can't quickly bring new supply online. Third, inventory collapse. Since 2020, COMEX registered inventory is down 75%, now around 82 to 103 million ounces. London LBMA vaults are down 40%. Shanghai inventories are at their lowest in a decade. At current consumption rates, some regions have barely 30 to 45 days of accessible reserves. So here's where we are, as of February 13th, 2026. March 2026 COMEX silver contracts begin delivery in 14 days. Let me give you historical perspective. Typical major delivery month sees 10 to 20 million ounces delivered. December 2025 saw 46.6 million ounces delivered. January 2026, which wasn't even a delivery month, saw 33 to 40 million ounces withdrawn. March open interest represents 366 to 528 million ounces. Registered inventory stands at 102 to 113 million ounces. What happens if delivery demand exceeds supply? Option 1 is cash settlement. COMEX pays the cash equivalent instead of delivering metal. This maintains the exchange, but erodes confidence in paper pricing. Option 2 is emergency measures. Increased margin requirements, which has already been done, position limits, trading halts. Option 3 is force majeure, declaring an inability to deliver due to circumstances beyond control. Will COMEX default? Here's what we know. Only a small percentage typically stand for delivery, historically 10 to 20%. If 20% of 400 million equals 80 million ounces demanded versus 102 million available. However, not all registered inventory may be truly free and clear. Analysts are divided. The bearish view says March will stress test the system, but not break it. Most contracts will roll forward or cash settle as usual. The bullish view says structural shortages mean March could see unprecedented delivery demand, potentially forcing cash settlements that undermine paper pricing credibility. The truth? We're in unprecedented territory. Historical patterns may not hold. If you own silver right now, you fall into one of 3 categories. Type 1, the paper holder. You own SLV, silver ETFs, or futures contracts. What you need to know is that most silver ETFs do hold physical metal, but during extreme stress, they may face redemption pressure or storage issues. Review your ETF's prospectus. Understand what you actually own. Type 2, the physical holder. You own coins, bars, or allocated storage. What you need to know is that physical premiums remain elevated even as spot prices fell. That's your signal. The crash was in paper, not physical supply. If you bought for long-term wealth preservation, short-term volatility is noise. Type 3, the prospective buyer. You're watching, waiting to enter. What you need to know is that current prices at $82 are 32% below January's peak of $121, but still 2.5 times higher than February 2025 when silver was at $32. If you believe the supply and demand fundamentals, pullbacks offer entry points. But understand, this is a volatile, speculative market. Here's what the data actually shows. During U.S. trading hours, particularly New York morning, large selling occurs, often in low-volume periods. Contracts are sold and rapidly repurchased, triggering price swings. During Asian hours, physical buying. According to customs data and exchange reports, China, India, and Middle Eastern buyers have been net accumulators. The divergence is clear. Paper market in the West shows high volatility and leveraged speculation. Physical market in the East shows steady accumulation of metal. This isn't conspiracy. Its market structure. Western markets are futures-driven. Eastern markets are physical-driven. Different incentives, different behaviors. The next 30 days will reveal whether paper silver pricing can withstand physical delivery pressure. Scenario 1 is a soft landing. March delivery proceeds normally. Some stress, but COMEX meets obligations. Paper prices remain primary price discovery mechanism. Silver consolidates in the $70 to $90 range. Scenario 2 is elevated tension. Partial cash settlements occur, physical premiums widen further. Market bifurcates, paper price versus physical price. This is already beginning. Scenario 3 is system stress, widespread delivery failures or force majeure declarations. Major repricing as physical markets take over price discovery from paper markets. Historical precedent includes the 1980 Hunt Brothers Corner and the 2011 Silver Squeeze. Which is most likely? Given current data, Scenario 2, elevated tension with widening paper physical spreads. Here's what you should take away. The $43 crash was real, driven by overleveraged positions and a billionaire's well-timed short. The supply concerns are also real, supported by exchange data, inventory declines, and physical premiums. March delivery begins in 14 days, and it will test whether paper contracts are backed by sufficient physical metal. This isn't about them versus us. It's about understanding that futures markets and physical markets have different dynamics, and right now, they're diverging. What should you do? That depends on your situation, time horizon, and risk tolerance. But here are the facts to base your decision on. Silver fundamentals show a supply deficit with industrial demand growing. Silver risks include volatility, potential for further paper selling, and regulatory intervention. Silver positioning means physical metal offers protection from paper market dysfunction. This channel doesn't tell you what to do. We show you the data and let you decide. If this video helped you understand what's actually happening in silver markets, not the hype, not the fear, just the facts, subscribe so you don't miss March's developments. Drop a comment. Are you holding, selling, or buying? And what question should I answer next? The silver story isn't over. It's just beginning.